Welcome to the Empowered Investor Podcast. Have you ever felt overwhelmed by the sheer volume of choices and voices telling you how to plan or invest for your future? With his straightforward approach, host Keith Matthews of Tulett, Matthews and Associates cuts through the noise to help you create a winning action plan for you and your family. The decision-making framework discussed in this show can transform you and your investment experiences and will increase your odds of becoming financially secure. Learn more and subscribe today at tma-invest.com.
Welcome to the Empowered Investor. My name is Keith Matthews and I'm joined by my co-host Marcelo Taboada. Marcelo, how are you today?
Keith, Happy New Year. 2024 was a very eventful year. How are you?
I'm good, thank you. Welcome everybody to the show. This is our first episode for 2025. We'll be doing a year in review. We'll talk about asset class returns. We'll talk about the major trends that we saw last year. We'll talk about major issues. And then we'll try to provide some perspective in terms of how to move forward. Marcelo, before we do that though, let's talk a little bit about some personal updates. What was the biggest thing that happened to you in 2024?
Well, there's two things actually. I became a father. So that was the biggest thing for me by far. It's been amazing and it's changed everything for me and my wife, which is amazing. It's a great moment.
How was your Christmas holidays with your extended family?
It was amazing, honestly. I mean, I already have two nephews and we've been in that vibe a lot in the last few years, but it changes the dynamic for the family and it changes the focus too.
Well, you go from couple to family.
Well, not only that, but like it's funny how the progression of Christmas is when you're a kid, all you care about is presents and gifts and stuff like that. Then it moves into you really start valuing presents, having a full table and stuff. So we were just grateful to have all those moments with the family at that time, and the baby was nice.
Very nice. Very nice.
And then obviously, professionally, we have a very strong succession plan in the company and became a shareholder in the business. And that's a huge step for me. If you tell me when I started like almost 10 years ago, if that would have been a possibility, I would have been like, no way. It sounds too good to be true. But it's a great business with great people and just the relationships we have with the clients is just amazing.
Yeah, we should do a show just to update our listeners in terms of how things have evolved in the company. But you're absolutely correct, Marcelo. We welcomed 10 new shareholders into the business last year. So Don, Tulett, and myself were the principal shareholders, and we've now welcomed 10 more, which is fantastic. It's really setting ourselves up for the future. Clients and contacts and individuals we know were very enthusiastic about the whole process. So it is a big moment.
Yeah. What about you?
So for me, Marcelo, it was all about real estate. I had finished a cottage, building a family cottage last spring. And in doing so, my wife and I reflected and we said it's time for us to sell our family home.
Yeah, that's huge.
And so in late fall, we embarked, or actually it took us a long time to get the house ready, but we ended up selling our family home of 24 years, buying a home half the size and doing an actual downsize. And I'd seen clients doing these types of moves my whole life. My wife and I have just done it at an earlier age than most. So I'm 60, 61. My wife is mid 50s and we downsized into a 1,200 square foot. It's not really a tiny home, but it is a smaller home than our family home. So
what are you going to do with all this time in your hands with gardening?
We had a house flood with the big floods that we had in August. So we ended up having to gut our house. Decluttering is a massive undertaking. I'm so happy that's behind us. We officially moved out of our home December 17th. We're lucky enough to be able to stay with a friend right now 3 or 4 days a week and then at a cottage 3 days a week.
You know, we have a lot of clients who are going through the process of downsizing. And I think the emotional part is the hardest, right?
So we've moved out and it hasn't been difficult emotionally, but it's quite a fatiguing process to declutter. So if you think about what you have in your home, in your basement, raising 3 kids, keeping all of the storage, you just start collecting things and it all had to go. So we've done that. And the place we're moving into will be ready in about 2 months. So we're doing some renovations. We're super excited. It's moving into Point Claire Village, which is a small little village. So it's great atmosphere. Looking forward to it.
Yeah, you may gain some weight. There's so many good spots there to eat.
Yeah. All right. Well, thanks for the update on the personal side, Marcelo. Let's jump into the numbers and let's jump into the year in review. So the way we're going to do today's show is we're going to talk about 2024, returns, issues, things that popped up, and then we're going to sort of zoom out and look at the decade, see how that worked out, and then maybe compare a couple decades and then provide some perspective.
Absolutely.
So how were the asset class returns last year?
honestly, it's been a great time for every asset class, essentially, in 2024. The story continued from 2023. So if you look at cash and equivalents, which is, we measured that by looking at different money market funds, which is like the shortest term cash that you can buy in the market, the risk-free, that was up 4.7%. Then we look at bonds, for example. If you look at world bonds, 1 to 5 year bonds, that's up 3.4%. The Canadian bonds are up 4.2%. So nice story for bonds. It was expected though. We knew that 2022 was a very bad year for bonds, but we knew those returns would be there when interest rates started going down and those prices started appreciating. So it's nice to see though that a lot of people hold bonds, and that turned out well in 2024. We're moving on to stocks now. The Canadian market did 21.6%. US stocks by far the best, 35.6%. You look at international stocks, that was up 12.6%, and emerging markets was up 16.6%. Lastly, we look at real estate investment trusts. Bit of a different story there. Global REITs were up 11.4%, while Canadian REITs were down 2%. So it's a bit of a dichotomy there that it's happening in the market. So yeah, that's an interesting to see. And then the other big piece of news for us as Canadians was the Canadian dollar depreciated almost 8% versus the US dollar. And that has a huge impact on Canadians because we trade a lot with the United States and we do a lot of business with the United States. And that affects equities and it affects the economy as well.
Yeah, that's a great summary. In essence, 2024 was an exceptional year for equity appreciation for stocks. You have to go back almost 20 years to the late 90s where you had back-to-back 20-plus performance years out of S&P 500.
That's crazy.
And so part of that S&P 500 story is the 8% depreciation of currency, Canadian currency. So if you're an American in the United States, the return was 27%. Often individuals last year would say, oh, it's just U.S. stocks that are up. But they kind of didn't realize that Canadian stocks had a pretty strong year. So for Canadian stock to be up 22%, that's a fantastic year.
It's what dominates the news, right? I think the S&P 500 is one of the most followed indices, and that's what it's more present in people's lives. But other markets had great years too, in and of themselves.
Yeah. So an all equity portfolio, depending on allocations, could have been between 20 and 25%, plus or minus, depending on what your allocations are to various different regions. But again, that's a pretty spectacular return. How about 60-40 portfolios? Let's talk about that for a second, because that's a classic benchmark. And that was under a lot of pressure 2 years ago, if you recall, Marcelo. 2022, you had negative bond market year, you had negative stock. And so 60-40 portfolios were down like 12, 13%, which we hadn't seen in a long time.
Well, I remember reading headlines all the time with the titles of, is the 60-40 death? Is the 60-40 even worth it anymore? I think that was a common theme in 2022. It was under a lot of pressure because if you look at the vast majority of retirees, that's sort of like the portfolio that everybody chooses by default. I'm not saying that's what everybody should do, but when you look at it broadly speaking, that's what most people do when they're like retiring and looking to take the risk from the portfolio a little bit. So that was down 12% in 2022 because of what you just described. But you look at the next 2 years and you're looking at returns of 12 and 15% for 2023 and 2024. So even our own 60-40 did 14% last year. So those are great returns. I mean, we're not going to see those numbers in 60-40 portfolios every year, but it's remarkable to see.
Yeah, well, you get a double-digit return for a 60-40 portfolio when bonds are returning anywhere from 3 to 5%. You know that stocks have to be doing exceptionally well. So it is one of the things we remind our listeners and our clients that the last few years have been incredibly strong, and we shouldn't bank on that all the time, of course, on a go-forward basis. We're going to have some bumps at some point. So what happened last year? What are some of the main themes that we want to touch base in today's show?
Well, there's a few obviously on the geopolitical side, but we're going to stay away from those. But I think the biggest ones on the economy and markets were interest rate cuts. There's also a bit about the economy happening there. Like we're seeing two different paths by the BOC and the Fed.
So hang on, just slow down. BOC, Bank of Canada.
Correct.
And Fed being the U.S. Federal Reserve.
Yes. So the Bank of Canada cut rates of about 1.75%. So that's 5 cuts, Keith. The U.S. was 3 cuts. Now, we don't have the European numbers, but if you look at the Federal Reserve Bank in Europe, they're also lowering rates at the same pace as Canada. It's not so much as the US, but you're seeing that globally, and the US is being a bit slower in cutting rates.
Yeah. And so this was all expected. As we went into 2024, the thinking was that the higher rates that had been in the marketplace would slow down economies and would allow banks, federal banks, to start cutting rates. So that's what we saw. In Canada, the rates were a little bit more aggressive by way of cutting. We had two what they call mega cuts, which is 0.5 of 1%, so 0.5%. We had two of those cuts, and they came in October and December. Obviously, that helps anybody that's borrowing. It helps anybody that's levered, mortgages, all these interest rates will come down. It also helps to spur on equity markets. And so this was something that most people had expected, and we actually saw.
And then the second one is inflation, obviously. So inflation is been back into the target of where they want it to be. It's anywhere between 1% and 3%. So we're now down to around 2%, which is right smack in the middle of the target. So I think that's helped the Bank of Canada saying we're comfortable lowering markets. Obviously, they're looking at other things like the labor market and GDP numbers. Canada's doing a bit worse than the US. And I think that's been the story of why the US is lowering rates or slowing down the lowering of the rates, because their economy turns out to be more resilient and inflation is a bit stickier than they thought in the United States. So those are the big themes that we saw in 2024.
There's a table we have that speaks to how equity markets typically do 1 and 3 years after the start of rate decreases. So last year was the start of the rate decreases. Yeah. So what are these tables? We look at a period here. We've got a table of maybe 10 different periods in the last 60 years where they started to cut rates. What typically happens?
So you look at the average of those, you have a total of 19 cuts on average per period. Then you have the returns after 6 months after the first cut are 5%. For the S&P 500, I may say. 1 year after the first cut, the average is 8% returns. And 3 years after the first cut, it's a 51% return.
51 cumulative.
Correct. So what you see is that, yes, markets tend to price in very favorably when interest rates are going down. Obviously, equities tend to do really well in those periods. So based on the data that we have, that's what we see.
Yeah, and it's not positive in every single time. It's positive. It appears to be in like 7 out of 9 times. But essentially what the data shows is once you start cutting rates, a few years after, you're looking at higher stock prices. What else? What are also some of the big themes for 2024?
Well, the other one, I think we alluded to that at the beginning, is the U.S. exceptionalism. So the U.S. exceptionalism means that the U.S. has done better in the stock market in the last few years. And that's creating some people to say, is it even worth it to invest in global stocks and Canadian stocks? And why don't we just invest in the United States? And it's fair to say, I mean, you pull the numbers here. And if you look at the last 10 years, effectively, the US stock market is the best performer. So if you look at the last 10 years for the S&P 500, that's a 15.5% return versus
16% annualized.
Yeah,
that's a huge.
Oh, it's insane when you think about it. And Canada is at 8.6. EFI markets, which is developed markets, it's 7.4. Actually, EFI and emerging markets, so if you look at the both for international markets, they're up 7%. So you have 7% returns, 8.6 in Canada versus 15.5 in the US. It's a big difference. And I could see why people would think that, right?
You're right, Marcelo. U.S. exceptionalism was a big theme last year. And I think it speaks to not just the fact that U.S. stock market had done so well in the last 1 year, 5 year, 10 year, but that so many things in the United States seems to be going well. U.S. productivity relative to other players in the world is off the charts. In other words, the amount of GDP per capita is just skyrocketing in the United States, and other countries are lagging. Canada's lagging. Europe is lagging. Profits also are something that people point to in terms of the U.S. market being that companies are exceptionally profitable, which you add up all these different factors, hence you end up with people attracted to buying U.S. securities, more so than other securities. And so American stocks tend to become pricier, so the multiples are higher. And so it's this snowball effect of like, you want to maybe be there because the productivity is higher, profits are high, and so the prices become elevated. And so this is the big tug of war that I think is going on in the marketplace right now, which is the case for U.S. exceptionalism, and then the case for, well, but other securities look so well priced relative to the U.S. stock market.
Yeah, we've seen this before, right? Like with value stock, where we're looking at, I think it was 2-3 years ago, we were looking at a report where we realized that value stocks, they were just not being loved. It wasn't even the case that they weren't good stocks or anything like that. It's just all the love was going into growth and other types of stocks. And I think we're seeing some of that here, where a lot of the love is going into AI companies, technology companies in the US, the Magnificent Seven, the top 10 stocks in the S&P 500. But the other stuff is not that it's bad stocks. It's just that they're not getting the love that they deserve, so to speak. And the thing too is AI, yes, I think you're seeing a lot of the returns going into the first mover type of thing, where it's the companies that own the proprietary technology now. But as this gets adopted all across the world, it will help everybody. And whether you're a manufacturing company and have nothing to do with AI, eventually you will end up benefiting from this. And I mean, it's not a prediction onto which specific economies or specific companies, but this is just common sense, you know, like the internet is the same principle, right? Like in 90s, people were moving into internet companies because it was a novel technology, but look at where we are today. The internet, it dominates the world, right?
But it took the internet companies 12, 13 years to figure out how to make money and how to do things correctly.
Yeah, correct. But when you think about people's portfolios, you're not investing for 5 to 10 years. Most people are investing for 30, 40, 50, 60 years.
Yeah. So let's talk a little bit about this Magnificent Seven concept. And we've got a chart here which speaks to S&P 500 returns, S&P 500 returns without Magnificent Seven, and then Magnificent Seven, their contribution to the return. So speak a little bit about Magnificent Seven's contributions to S&P 500 returns.
Yeah, so if you look at the last 2 years, which is the 2 exceptional years, so this is in US dollars, by the way. So if you look at the S&P 500 in 2023, the return was 24%. The Magnificent Seven contributed to 63% of those returns.
Yeah, so said another way, if you strip out the Magnificent Seven, instead of getting 24%, you would have gotten 8%.
Correct.
And in 2024, if you strip out Magnificent Seven, instead of 27, like we talked about in US dollars, instead of 27, you would have gotten 12%.
It's crazy.
Those are big numbers.
Yeah.
Which is why I think that when you look at some of the reports coming out of certain organizations, on a go-forward basis, there are organizations now coming out and saying the go-forward expected rate of return out of the U.S. market will be quite a bit lower than what most investors expect. So this is this concept of U.S. exceptional. Has the U.S. always been an exceptional place to invest?
No. And I think we had a podcast on the subject and we've looked at the numbers. And I think the recency bias is what happens here. Just because something happened in the last few years doesn't mean it will happen always. And I think this is just human nature, right? Like we are prone to these behavioral biases that are present in the market when these things happen. But if you look at the lost decade, for example, which is the period from 2000 to 2010, so one full decade, the US actually lost money. Their return was negative minus 2.6. Is negative 2.6.
Well, it's negative 2.6 annualized returns.
Correct.
So how old were you, Marcelo, 2010? What were you doing?
I was probably around 22, 23, and I was a university student.
University student. Okay. So let's say 2008, 2009, I remember vividly.
Yeah, I was in CEGEP back then. I had just arrived to Montreal. I remember that time. It was very uncertain for university students.
Now, let me ask you a question. So you were a new immigrant, a new Canadian, and I presume your English was okay, coming from a Spanish background, and you had to improve your English, you had to improve your French, and you had to go to school, you were working part-time. That's quite a story. You should be very proud of the accomplishments that were made. But do you ever remember anything about the stock market and where to invest in the world? And was that even a concept that you were thinking about back then?
Yes and no, because obviously I was studying economics and finance and all that. So people talked about it in my circle. I remember people they were more in love with the oil stocks at that time. I do remember that. Oil was around $120. There was a lot of talk about those type of stocks. Not so much in the US because you're coming from a lost decade. Obviously, 2008 was still very present. So yeah. That's what I remember, but not much.
Well, it's pretty good memory. I mean, I can tell you from an advisor perspective that it was very hard to convince people that they should have money in the US stock market. So if you look back from 2010 earlier, what you ended up with was this minus 2.6 annualized, which is like minus 30%.
That's
over
crazy,
a decade. And Canadian stocks were up 6% over that same decade.
6.5.
6.5 annualized, which means it's 10% gap for an entire decade. What we used to hear was, why would we invest in the United States? They created the credit crisis. Their financial institutions are a mess. Their insurance companies are collapsing.
People are leveraged.
Their brokerage firms are collapsing. Unemployment rates are skyrocketing.
Debt levels were super high.
People were overextended in homes, overextended in mortgages. Why in God's name would you invest in a country that was falling apart? And hence, a decade later, here we are talking about U.S. exceptionalism. And it is. We're not taking away anything with regards to the wonderful things that have occurred in the U.S. economy, because it is a strong economy. It is a place of innovation. But we're just talking about having perspective here. And here we are today saying, how do you have perspective on a go-forward basis? And do you get caught up in these different stories? We would argue that obviously not, and you have to keep a very balanced approach.
Yeah, and we've had the questions from clients, not many, but we have people asking. I have friends ask me all the time, why would anybody invest in Canada and international when we have the S&P 500? And I always walk them through the numbers and I say, look, at the end of the day, yes, if you look at the last few years, the US has completely obliterated every market. But you also don't want to be in a situation where you're leaving out great countries, great economies that are growing, and also great companies, because Europe and international markets are also filled with great companies. They're not only in the United States. So think about the European companies like Nestle and stuff like that, Toyota in Japan. You want to have that stuff in your portfolio too. You don't want to leave that out.
Yeah, 100%, 100%. Well, there's another interesting thing I would like to touch base on in the last decade. So the last decade, we've spoken about how strong U.S. stock markets were, and Canadian stocks did reasonably well. International stocks lagged a little bit more. Bonds. Let's talk about bonds for a second here. It was a tough year. It was a tough decade. Bonds were positive last year, but it's been a tough decade. So if we look at the last 10 years, average bond prices are up about 1.8%. Inflation over that very same 10-year period was always low for the first 6 or 7 years. Then we hit the pandemic and it went to zero. And then post-pandemic for 3 years, we averaged about 5%, a high of maybe 8%. Over 10 years, we had inflation somewhere in the vicinity of 2.7-ish. So here we've got bond portfolios producing returns that are negative versus inflation. So they can't keep up with inflation, and that's pre-tax. This is very different than the 1990s. For our clients that will remember or listeners who remember the 1990s, you might think about being able to buy a GIC or a bond at 8, 9, 10% and having inflation around 3%. So you had a 700 basis point real return on a bond. We've just gone through the entire decade where it hasn't paid to own bonds. So the only thing that's kind of kept your purchasing power alive, in other words, something that grows as fast as inflation or more, there's just been two things. There's been homes, real estate, and stocks. So the conservative investor has not been rewarded for being conservative in the last 10 years.
And homes is tough because they're not liquid, right? Like you can't fund your retirement with a home.
Yeah.
Unless you do a reverse mortgage or you sell your home, right?
Yeah.
But not going to do that.
Yeah. So it goes back to this whole thing about perspective. The decade prior, bonds had a better decade. But this last decade, it's been particularly difficult for bond investors.
It's been rough. And I think it's nice to see people getting paid now for bonds. But I think they will always have a place in a portfolio because you need them to stabilize a portfolio. It's a shock absorber. It's a whole different relationship than equities. But it's been tough to see.
Well, one of the lessons that I think as a takeaways is that when you do have inflationary periods, it is not kind at all to bonds. And bonds just simply cannot keep up. They get hit hard, and even the recovery period takes many, many years to gather momentum again so that you've got positive break-evens.
Yeah, it's great for the people who owe the money, but it's horrible for the people who own the debt.
Yeah, absolutely, 100%. What else happened? We can't have a year in review without talking about U.S. elections.
Oh, yeah.
This is not a political show, but obviously that was a big moment.
Well, I think it was a big moment. If I remember correctly, it was the biggest year for democracy in the sense that India was voting, Indonesia was voting, a lot of countries around the world that are considered democracies were voting. And sadly, the trends, as we were talking about off mic, it's that a lot of governments are crumbling right now. If you look at the G7, the only two stable governments are Italy and the US, and every other country is going through an election or some sort of like political problem. So I think that was that big theme in the political landscape in 2024. Germany's having an election in February. We're having an election probably in the next 2 to 3 months, possibly. France is also going through a lot of political problems. It's not fun to see, but it's going to be a challenging year, I think, in that sense. But it has nothing to do with equities, by the way.
Yeah, well, listen, you could have a challenging year, and sometimes you need challenging years to make important changes, which will have fundamental impacts on economy and on how your society works. So let's kind of wrap things up a little bit here, Marcelo. It's been a great discussion. In particular, we looked at the 1 year in review, and then we sort of zoomed out for a 10-year review. How should we think about things on a go-forward basis?
Well, I think about the big themes we always say, diversify, don't focus on narratives because they are catchy and we tend to fall for them sometimes, and that's just who we are. But I'd say focus on the diversification and the idea that, yes, it's not good, right, to just put everything in one market. But if we think about on a go-forward basis, diversified portfolios don't look so bad. And yes, we're going to still get some US equities, but if you look at valuations, Canadian equities look attractive, international equities look attractive, emerging markets look attractive. So it doesn't mean we're going to get the return. We can predict the return, but we know that because we're paying less on a go-forward basis for that extra unit of earnings, it makes sense to do it. And I would say to the listener, diversification pays. There's always going to be something you don't like, but it pays off.
Yeah, it's very sound advice. I can't help think, since we're doing this sort of 1 year review and even a decade review, that I go back in time and I look at all these different decades. And if you were able to identify what would be the best asset class each decade, life would be so simple.
Well, you always tell me, like, if we played that game, all we should have done since the 90s is buy single family homes in the West Island. We would have had the best returns. But life doesn't work that way.
No. So to me, the issue is really keeping perspective. As much as your emotions want to tug you into saying, let me just do this one thing with my portfolio, that is just no way to manage money. And you can look back in time and go, wow, I would never have predicted that. And so here we are going into 2025, stay diversified, own lots of stocks in portfolios. These are things that will keep purchasing power. Maintain exposure, keep your plan, stay diversified, own Canadian stocks, US stocks, international stocks, and emerging market stocks, own REITs, have exposure to some real estate, and depending on your nature, look to have the fixed income in your portfolio.
Yeah. And if I can just say lastly, one of the things that struck me the most last year, I had a conversation with someone, and it's not a client, it's somebody I know, but they said something to me like, how can you invest in the stock market when the world is collapsing? We have so many wars, political instability. And I remember thinking, and I didn't say this to the person, but I almost stuck myself and say, I should have said that. But going home after and thinking, I was just thinking that the world has always had these issues. We've always had wars. We've always had political instability. And one thing we know is that the stock market has been resilient. People are resilient. And it's worked out well if you look at historically. So we've always going to have this type of problems in the world, but we have to separate from the narrative and focus on the fact that historically stock markets trend upward, and it's because people want to do better in their lives and they're resilient and they pull through.
Wow. Well, on that optimism, Marcelo, we're going to end today's show.
Thank you.
Thank you very much for a really nice conversation to start the year. And to our listeners, we would like to wish you, on behalf of our entire team, a wonderful 2025.
Happy New Year.
You've been listening to the Empowered Investor Podcast, hosted by Keith Matthews. Please visit tma-invest.com to subscribe to this podcast, learn more about how his firm helps Canadian investors, or to request a complimentary copy of The Empowered Investor. Investments and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use their best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.